Good morning from our global headquarters in New York. I'm Manus Cranny with Denny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Meta's disappointing forecast in AI spend shakes tech investors with more Mag 7 earnings on their way. Mining giant BHP approaches rival Anglo American with a takeover offer. Anglo considers a sale of its diamonds unit De Beers. Plus, an avalanche of earnings in Europe. Deutsche Bank reports a beat on fixed income trading revenue.
Good morning. It's like the field of dreams. Tech came to die last night. Meta got trounced down by 19%. It dragged the entire complex lower. Meta is still lower this morning by 13%. Asking for patience, patience with my capex, patience with my dreams, was not rewarded for Zuckerberg, but it was by Elon Musk. It is about the capex and the spend, 35 to 40 billion. That is more than the market had anticipated for the future, for the dreams. That's the spook. 10-year yields this morning are virtually flat on their knees. We're waiting for another auction today. Today it's about the sevens, $40 billion worth of 7-year paper will come. You've got Brown Brothers Harriman saying demand is solid, even though they had to cheapen up ever so slightly yesterday to get the auction away. Dollar yen, we are on constant intervention watch, because the very definition of what Candace said is the moment of intervention is when dollar up by 4%, yen down by 4% in the space of 2 weeks. That rings the bell for intervention. Good morning, Ms. Berger.
Good morning, Manus. And we have a little bit of breaking news to start our morning off with us. There's a new CHIPS Act winner. Micron is the latest, Manus. This confirms our reporting last week. So the details, the U.S. is going to award Micron $6.1 billion in grants, $7.5 billion in loans. The idea, help them build a new factory in America. It's the latest and potentially one of the last of these awards we're going to hear from the federal government.
Well, it's certainly going to be interesting to see how this administration plays this out into the election, which is about bringing home business to the shores of the United States of America and really ring-fencing the integrity of chips. Just think of the list. Intel got $20 billion in grants and loans. That was in March. TSMC got $11.6 billion. That was in April. And Samsung, $6.4 billion in grants. They did not get loans in April. So again, there's a deeply political message here as well about making America independent within the chip spectrum. But of course, your biggest ally is Taiwan. What does all this mean for your relationship with Taiwan?
Yeah, there's been some excellent reporting, a lot of it from the New York Times, about the cultural differences at TSMC's Arizona factory. Highly recommend that for a read. But Manus, you know the
cultural differences.
Yeah, that's us. Yeah, we mesh though. We do okay. Yeah, I lived in the UK long enough. I kind of get it. But Manus, we have to talk about the tech elephant in the room. It's not the CHIPS Act winners. No. It's Meta. Painful this morning. I think it's down 12.5% in the pre-market so far. Oh, 13. There we go.
This comes down to which CEO set of dreams do you believe? That is what this comes down to. Okay, that's being a bit facetious. But it's about which CEO do you back? Do you back Elon Musk or do you back Musk? That is the question.
Right, but the difference here is that after Meta's last earnings, it had a record surge. It added the most market cap ever for any company versus Tesla, which was beat up to its earnings. So maybe the bar was just different between the two.
Indeed. So what can we expect for this year?
As we're scaling capex and energy expenses for AI, we'll continue focusing on operating the rest of our company efficiently. But realistically, even with shifting many of our existing resources to focus on AI, we'll still grow our investment envelope meaningfully before we make much revenue from some of these new products.
Alex Webb is standing by to talk us through his take on this. To quote Mr. Zuckerberg, smart investors see the potential in AI and Reality Labs even before they make money. Trust me, I'm a genius.
I mean, it's a pretty simple calculation as to why we're seeing the stock decline right now. They've spent the past year telegraphing the fact that they care about shareholder value, that they are going to reduce their expenses, that this is a new Facebook. Then suddenly, not only have we seen a slight anticipated slowdown in growth in terms of what the market was expecting compared to Facebook's own or Meta's own forecast, but also they're going to be expanding spending. That sort of says, actually, we're a slightly longer duration stock than you thought. We're pushing out some earnings in the expectation given them in a few years' time. In this high interest rate environment, investors don't have as much patience for that sort of thing as they might have done a few years ago.
I mean, I thought Meta learned this lesson last time, as you said, Alex, when they were punished and then decided to unveil the year of efficiency, perhaps, which is no longer that. We're also going to hear from Microsoft. Clearly, their AI push is one of also spending and also dominating perhaps some of the earnings. What matters then for shareholders in analyzing their earnings?
Yeah, Microsoft is really about seeing whether all that expense on bringing AI capabilities, particularly into data centers, is yet starting to reap rewards. When we think about Nvidia and the huge surge that's been on, it's because companies like Microsoft and Google and Amazon, and now increasingly Meta, are buying their chips to kit out their data centers. They do that with the expectation that then companies will port more of their processes into AI and onto their cloud. Investors really want to see now that that investment is paying off and that indeed that AI revolution is in fact happening.
What is it that Alphabet need to convince the market of this evening? For them, it is about the advertising dollar. Economies are strong here in the United States of America, and globally we've had a robust performance. But what is it that Alphabet needs to convince the market of? The stock is up 14% this year.
So there's a strong cloud piece here. For quite a long time, Google has been trying to reduce its dependency on that core advertising business, which accounts for, the majority of revenue and indeed earnings. And AI seems to be providing it a little bit of a tailwind to make that happen. So on that basis, it's a similar story to Microsoft, but still advertising is, as I said, the lion's share of its business. The fact that Meta has telegraphed a little bit of softness in that space, softer at least than what had been expected, will mean there will be attention on that at Google. But don't forget, Google is the place that if you are in the business of selling anything, certainly consumer products, you need to be advertising on Google. It is the first place that people will spend their advertising dollars, the last place that they will almost certainly give up their advertising dollars. So it has a lot more resilience than Meta, and there's therefore quite a lot of enthusiasm about the prospect of riding the coattails of the economic resurgence.
Okay, it's the last place you're going to cut your spend on Google. Alex, thank you very much. Alex Webb. Our next guest says this about Meta. Spending needs to be targeted in line with a clear strategic view. The see what sticks method of years gone by won't be tolerated by the investor base. Meta's resources are vast, but they are not infinite. Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Sounds like your patience is running thin for Mr. Zuckerberg's future dreams.
Hi there. Yes, I think you could probably say that, really similar to what Alex was just saying. This is a direct reversal of what investors have been promised, and particularly in this higher risk, higher rate environment, I would argue that now is not the time to be trying to hard launch extreme spending plans once more. The reason that the market had thanked Meta in recent months was because it was very much understood that pretty significant AI investment was absolutely going on in the background, but there'd been this really core refocusing on the main traditional business elements, and they've kind of scrubbed that all out and spooked everybody again is essentially what's happened.
Do you think that this is a Zuckerberg, Sophie, that is willing to go back to basics, willing to go back to focusing on ad? Because, again, as I said to Alex, I thought he learned that lesson when shares last year were punished and he unveils the year of efficiency. Do you think he's likely to go back to that, or have we lost him at this point if he reverses course?
I think at this stage, I'd actually be quite surprised if he reverses once again. And what is slightly worrying to me, really, is that this method that the market seemed to be supportive of was this idea of a bit of half and half, right? Absolutely go away and work on these moonshots and these AI capabilities, but at the same time remain focused. It was a 50-50 approach. What seems to be happening here is we've gone all the way back to all or nothing. And I don't think that we're going to see a reversal of that again at this stage. Now, of course, nobody is arguing that AI should be forgotten about or underinvested in, but I would argue that this is a bridge too far for this current moment in time in the market.
And yet the language differential between Musk and Zuckerberg was very clear. Musk saying to the market, look, if you don't believe in my future of robo-taxis, get off my shareholder list. And Zuckerberg actually taking a similar, if you don't believe in the future of AI, then you're very much mistaken in your interpretation. Let's move the agenda along because we've got a lot more to get through in terms of Microsoft along with Alphabet. I want to focus in on Microsoft. You say it has muscled its way to its pole position in the AI race. And Dan Ives would agree with you there, which is over at Wedbush. This is the iPhone moment for Microsoft. Is it as evangelical a moment as that?
I certainly think it could be. I mean, the reason that Microsoft, or that I'm so, and I think most people are so bullish on Microsoft at the moment, is because that path to monetization from AI is really, really clear. It already exists, you know, the ways that it can be embedded into existing products and processes. So that for me is huge and is something that I think potentially gets overlooked, just that technical element of, you know, it can be embedded in things it's already selling. And I think that really for me, I do think that there's further upside to come. Of course, now I've jinxed it, now I've said that. But I think absolutely that Microsoft is in a brilliant spot in this race. That said, not to fully contradict myself, you know, in the scheme of things, we are really at the very early stages of this AI race, really. Yeah. So we do know that these things can obviously change at short notice.
And they have plenty of companies snapping at their heels too, Sophie. Okay, let's round it out for the earnings bonanza we're going to get today. We're also going to get Alphabet. We learned from Facebook that their projection for ads were in the mid-range. Digital ad prospects maybe not as strong as we thought. Does the same translate to Google? It's obviously down heavily this morning, not heavily, but more than 2% for Alphabet. Can we say, okay, Facebook's ad revenue wasn't as strong as we thought for their forecast, therefore I'm concerned about what Alphabet delivers today?
Yes, there is a part of me that is quite apprehensive, as much as I agree that Google is the be-all and end-all if you're trying to market anything these days. It's not a shoo-in, it's not a definite in terms of capturing spending dollars at the moment, especially when we start to look at smaller, medium businesses that are potentially going for more nimble options on the likes of Meta's platforms. And also we know that there has been some weakness from Alphabet. You know, we've heard from WPP today that there's been a slowdown in ad spending from tech companies in North America and China in particular as well. So just all in all, the global picture for ads is looking a little bit more challenging than I was certainly hoping for.
Sophie, we're going to catch up with Nancy Tengler a little bit later on, and part of her thesis is about the cash generation aspects of the balance sheets and the robustness, the financial robustness of big blockbuster tech in America. Does that pillar play into any of your thesis, or is yours very much predicated on the show and tell narrative of the future with discipline?
It absolutely has to have both, in my opinion. You know, for me, the absolute cornerstone, the backstop of these stocks is their balance sheet, because for me, it's lovely to get carried away with the future, but you know, for me, I'm quite traditional. And if you look at the financial resilience there, you know, look at Alphabet, you're looking at over $100 billion just sitting on the balance sheet. However, one thing that I would say against that is that there certainly is an argument, in my opinion, that more could be done with some of those balances. I think they are a bit too extreme, and sometimes it would
you like to see bigger dividends? Would you like to see bigger buybacks and dividends? Briefly, sorry for interrupting.
Yes, I think. That's okay. I think absolutely that would be something that could be a more prudent use of some of that cash. You know, they're so phenomenally huge. They don't need that much money sitting on the balance sheet.
Sophie, thank you very much. Sophie Lund-Yates of Hargreaves, Lansdown. A real reality check on big mega tech. Okay, other stories trending on your Bloomberg terminal. Are there any other stories apart from big tech? Well, U.S. Secretary of State Antony Blinken raises the concerns about unfair trade practices. These are in his meetings with senior Chinese officials. He underscored the need for a level playing field for the United States firms while in Shanghai. Blinken will meet with the Chinese foreign minister in Beijing on Friday.
And meanwhile, Columbia University backs President Namat Shafiq, defying calls for her ouster. In a statement, the university's board said it supports Shafiq's approach to managing diversity of voices on campus. Columbia's faculty has been given the option to hold classes online as protests on campus continue.
Sales at Nestle sputter. The maker of Nespresso coffee was hit by cooler demand in North America and supply constraints at its vitamins unit. Nestle shares fell as much as 5% in early trade. That's its biggest decline in 2 months.
I just ditched my Nespresso machine for one of those fancy espresso ones.
Too expensive.
I got it as a present, so that's my justification. Not from Manis, it's okay. All right, coming up, we're going to discuss the biggest shakeup in the mining industry in over a decade. We're going to dig into BHP's offer to take over Anglo American.
And Barclays, Deutsche Bank and BNP Paribas beat the expectations for the quarter. We'll unpack the latest results. Context matters on Bloomberg.
It's Bloomberg Brief. Danny Berger and Manis Cranny in New York. Some deal news for you. Shares of Anglo American are surging in London, up some 12.6%. Its rival and the world's biggest mining company, BHP, has offered a takeover bid that would value the company at almost $39 billion. Let's bring in Bloomberg's Will Kennedy from London on this. Will, I mean, this is the biggest deal of its size, the biggest shakeup in at least a decade. Why Anglo American and why now?
Well, BHP, I think, have been thinking for a while that it might want to do big deals again. They haven't always gone terribly well for them in the past, but the current CEO, Mike Henry, has, I think, tasked his management team with looking at deals like this. What does he want from this? Well, he wants Anglo American's copper assets. It has a very nice position in Chile, the world's largest copper producer, and copper is the metal of the moment. Most people are very optimistic about its demand outlook because of all the copper we're going to need to electrify the global economy. Think electric cars, think new grids, that kind of thing, at a time when supply is fairly constrained. So he has a bullish view of the copper market, and this is a way to increase his exposure to copper. The combined companies would have 10% of the global market.
Will, that draws the very natural question, which we understand the thesis. Capture 10% of the market, deliver the efficiencies. I'm sure that will be part of the narrative, scale, efficiencies, etc. But then you're going to have major competitive antitrust issues, are you? Where are they going to be most present? I know there's a South African business, but where do you see the antitrust issues?
So there are two big obstacles, at least, to getting this deal done. The first, I think, let's talk about antitrust first. We saw in the previous round of consolidation, when Glencore bought Xstrata, that China was willing to intervene in those deals. Now, while there aren't any Chinese assets at play, China would be far the biggest customer of these companies. It takes about half the world's copper, and so has an interest in perhaps not seeing a more concentrated copper mining industry. So it may have something to say about one company having 10% of the global copper market. The more immediate problem to getting this deal done, as you say, Manis, is South Africa. Now, already in their offer, BHP says it's contingent on Anglo American divesting itself of its platinum mining business in South Africa, its iron ore business in South Africa, both fairly troubled businesses which do not add much to BHP's portfolio. But the problem they have is that the biggest shareholder in Anglo America is owned by the South African government, and they will want to protect South Africa's interests.
I'm afraid we're going to have to end it there. This won't be the last time we talk about this, I know. Will Kennedy, thank you very much.
Bloomberg Brief, I'm Manis Cranny alongside Danny Berger in New York. Let's get you through the front pages. What else do you want to read? Here's what's making headlines around the world. First up, we have a deeply divided Supreme Court, Danny. The New York Times reports there was a 2-hour questioning. That was on Wednesday, with the justices arguing whether federal law should allow emergency abortions in states that have near-total bans. Now, the case is focused on the conflict between the state of Idaho and federal law. Now,
next up, Manis, Boeing is on the front pages of the Wall Street Journal. They had their earnings that showed a near $4 billion cash burn in the last quarter. The financial hit, this won't surprise you, stemmed from the Alaska Airlines mid-air accident. Adding insult to injury, Moody's also yesterday downgraded the firm's unsecured debt to a BBB rating.
Now, I love this story because this is what I dream of being able to do one day. But of course, I'm nowhere in this league. It is the Jefferies...
Dream big, Manus.
Dream big. Dream bold. Jefferies CEO, Rich Handler, he sold $65 million worth of shares in the firm, partly to buy himself a yacht. It is the first time that the CEO has made a stock sale in 34 years. So, you know, to be fair, if it's the first time you've done something like that in 34 years, why not have a yacht? I mean, it just sort of shows, you know, that's somebody who's locked up their wealth, built a business, and now they take a little bit out. It's 7% of his aggregate holdings, so he's not exactly bailing on Jefferies.
I was going to say, if we don't mind Jeff Bezos selling all of his Amazon shares just because he moved to Miami, then why should we care if someone did it to buy a yacht? The thing I don't understand, Manus, is why not do the thing that most billionaires do? Just use your shares as collateral and take out a loan to buy the yacht. Then you wouldn't have to deal with all these questions. Maybe interest rates are too high.
You're working on the assumption now that he hasn't leveraged the stock.
Oh, that's a good point. I was going to say maybe rates are too high, and this purchase of a yacht is a reason the Fed should cut.
There you go. Who wants to borrow money at LIBOR plus? Well, it's not LIBOR anymore. It is. That just shows you how old I am. Who wants to borrow money at 5% plus 2% extra for the yacht? I'm sure. Maybe he's got good terms from Jefferies on a revolving credit line. What do you reckon?
That'd be excellent. I'd hope so. The man has done enough for them. Hopefully, they'd give him that at least.
See, praise indeed from Danny Berger. Keep an eye on dollar yen. She wanted this in so badly.
I did. It's important. It's crossed 155, Manus.
Crossed the Rubicon.
It has, and today kicks off the first day of 2 of a BOJ meeting. What do we get tomorrow? A surprise hike?
Oh, maybe a little bit of an intervention like you got in 2022. But there's one lady, she's on the side of the set, Nancy Tengler, CEO of Laffer Tengler Investments. What does she think of big tech?
From our global headquarters in New York, I'm Danny Berger with Manus Cranny. Let's set your agenda.
Meta's disappointing forecast and AI spend shakes up the tech investors with a Mag 7's earnings more to come. Mining giant BHP approaches rival Anglo American with a takeover offer. Anglo considers a sale of its diamond unit, De Beers. Plus, an avalanche of earnings in Europe with Deutsche Bank reporting a beat on fixed income trading revenue. Danny, it is all about getting shaken up with big, bad tech.
Yeah, I was going to say good news for the banks, bad news for tech. Beautiful alliteration, Manus, as always. It's been a tough 24 hours for these markets. We're off the lows of the future session. We're down more than 1% on the NASDAQ at one point, now down about 0.9%. Meta still down 13% after their earnings. U.S. 10-year yields, those are little change this morning, 4.6%. There was a slight sell-off in debt yesterday, really led by Europe and Australia. A lot of auctions, record auctions. They've been absorbed. They've been fine. They did demand a little bit of a higher yield yesterday for the 5-year auction today. We're going to get $44 billion worth of issuance for 7 years. Finally, dollar yen. Manus, you and I were just talking about this. We're back above 155 per dollar. Everyone's screaming intervention, but we're going to get a BOJ decision tomorrow. Oh, and not to mention US PCE, which might exacerbate this if it comes in strong. Jane Foley over at Rabobank saying the MOF will probably be hoping that the Bank of Japan, Manus, can offer some hawkish commentary after Friday's policy meeting.
Yeah, well, according to the narrative from the Bank of Japan, it is about a move of more than 4% over the space of 2 weeks. That would invoke the wrath of intervention that we saw in 2022. But there's no doubt about it. That movement in Meta, Danny, is the momentum driver, and it's interesting because it's about two different CEOs, but both basically saying, be patient, we have a dream, we have a future. One of them managed to sell it to the market. His name was Elon Musk, although the bar was low.
Yes.
And the other is Zuckerberg, who's basically saying, if you can't see the beauty of AI, then you don't have enough vision.
But see, this is the thing with Musk. It's always been what you see is what you get. He's always had this line. Versus Mark Zuckerberg, who late last year said, this is the year of efficiency. We're going to rein spending in. Instead, we got a very different Zuckerberg on the call. Manus, I picked out this quote from him. He said, to your point, historically, investing to build these new scaled experiences in our app has been very good long-term investment for us and for investors who have stuck with us, saying, doesn't it pay to be loyal? Joining us now is Nancy Tengler, CEO of Laffer Tengler Investments. Musk there not Musk, getting my CEOs confused. Zuckerberg there also pointing to things like moving from desktop to mobile, investing in Reels, all of that paying off. So do you trust him this time around, Nancy?
No.
Okay, why?
We don't own the stock. We sold it a while ago. You could say I was wrong, but we bought Spotify, so you could also say we were right. That's the dilemma of being a portfolio manager. But I think to ask investors to be patient is never a good plan for any CEO. You need to lay out the vision. And even though Tesla's CEO, Elon Musk, was long on promises and short on specifics, he has a history of doing that and ultimately delivering. And so I think this is going to be a difficult, rocky period for Meta.
You were just so emphatic. No. I mean, I know you don't answer that, you don't own the stock, but no. Do you trust the CEO? No. I mean, here is the issue, which is it's about a belief of product and it's about a belief of delivery. When you see CEOs that keep extending CapEx higher with perhaps more mediocre guidance on the revenue in a higher for longer environment, is that what challenges growth even more so at this moment in time?
Yeah, and I think you could argue, we used to own the stock, and I think you can argue that he hasn't learned his lesson. It's, listen to what I say, and you nailed it in the opening, Danny. I mean, we've been here before, where the CapEx for the metaverse, and now we're in AI chat box spending. Whereas I think with Microsoft, the use cases are multiplying in generative AI. And so, we own ServiceNow. They had a fantastic report last night, if you ask me. The stock's down a little bit this morning. But Bill McDermott is an excellent CEO. He's delivering mid-20% earnings and subscription growth. I'm sorry, revenue and subscription growth. And he's a hell of a salesman. And that
he sold himself to you.
Yeah, but Nancy,
I've had a little crush.
Okay, yeah, why not? But Nancy, why can't I say, sure, Zuckerberg wants us to trust in the future he's building, but why can't I give him the time? Because he's one of many companies that have this fortress balance sheet that pays off as long as rates are high. Why doesn't that afford him more time?
I mean, you can. I think there's better places to be, particularly in the AI realm. I haven't used the Facebook or Meta chat box, but it feels more to me like low on productivity and high on time wasting. And so that's not what we're looking for. Our analogy to the 90s is because I was managing money then, and productivity saved the day. And I think that's what we're going to see with generative AI in this next few years. It's going to actually deliver productivity improvements.
And that's why you believe much more in the Microsoft, the thesis, the delivery, the potential to deliver, even more aggressively. They've got their open AI. They have a much better narrative to sell you.
Absolutely, and I think and that's also the case with Now. They are taking IT spend share from others, and so that's something that you want to look for. They're in the sweet spot in the generative AI cloud computing area, and Google, I think, is even in a better position than Facebook going forward. So they're starting to act like a grown-up company.
Right.
Moving protesters out of the company and setting some parameters for their employees that most of us live by every day.
Right. Manus, can I ask Nancy the question that we both want to ask?
Why not? Let's have a go at it.
Nancy, I'm so sorry. It feels like we're asking you this every time you come on. I promise we'll stop one day.
I think it's a fair question. It's a great benchmark. You're very honest. I will give you that.
True.
So we'll take it away.
So you can give me more than that.
Very honest. I can give you outstanding, actually. You roll with pretty much any punch that we throw at you.
But this is the thing, Nancy. You stick to your principles, and one of them has been Nvidia is too expensive. So here's the question we ask you every time. It falls 13.5% next week. Did you buy, Nancy?
Well, we didn't, but we're waiting still. I think it needs to be a little bit cheaper for us. Now, if you look at traditional metrics like price-earnings ratios, the stock's not expensive. We use relative price to sales ratio with growth stocks. So what am I paying for a unit of sales? And it's still a little bit expensive. Now, I did put in an order to buy it personally, but I kind of missed it again. So I was busy doing, who knows what. But yeah, so we want to own it for our clients, but we still are pretty happy with our AI exposure across the board.
Yeah, at least you have some exposure, even if it's your personal portfolio. That counts for something, I think.
There you go. Look, there's been big dislocations, hasn't there? I mean, if you think Tesla was down 40% before it went into the earnings.
We bought.
You bought it on the dip, did you?
Mm-hmm. We did.
Okay, just from a price action value or belief in robo-taxi and his narrative, which is, I'm going to come up with a Model 2 at the right price at a lower production cost. Which bit did you believe?
Long on promises, short on specifics. We own the stock for the mega battery, mega pack utility grade battery end of the business. It's fastest growing part of their business. We think it's going to be bigger than cars in 3 to 5 years, and it's the most profitable business. And they're the low cost producer in the industry. So I think if you're a believer in renewables, that's the part of the business that you want to be focused on. But it trades as a car company, right? It trades on EV numbers, on demand. I think 3-5 years from now, we're going to be having a very different discussion. And last thing I'll say, I commute a third of a mile every day, and in Arizona, I can't get in my car and get to the office without seeing a Waymo coming and a Waymo going. So even though in New York City you probably don't have much exposure, they're all over Phoenix and Scottsdale. And I do think, Tesla has 300 billion driver miles in the books. So they're learning, and they're going to be second to market, and that's not a bad place to be in many cases.
She just burst our little New York City bubble.
Well,
get outside a little bit.
Yeah, but you see, that is the whole discussion around politics and stocks. There's a metropolitan elite that talk about politics and talk about stocks in a very different way to the reality on the ground.
Yeah. I mean, it's true, as is evidenced by the Teslas, the Waymos elsewhere in the world, Nancy.
Nancy, good to see you. Sorry you didn't manage to get any of the stock on board for the PA account.
Oh, God. I'm buying it today.
You're buying it. Nancy Tengler there of Laffer Tengler Investments. Rolling with the punches. Coming up in the show. Well, Hermes defies the analyst expectations. Waning demand from China. More on the context that matters for Hermes. Bloomberg Brief. I'm Analyst alongside Danny Berger in New York. So we've had Deutsche Bank's numbers, and the investment bankers, they stepped up to the plate last quarter to help the German bank deliver a revenue beat. The CFO, James von Moltke, projects continued recovery.
The recovery in the wallet in corporate finance will continue across the year. Q1 was obviously very strong in debt products, so investment grade and a recovery in non-investment grade. We do expect that to continue and hopefully see a further recovery in M&A and equity activity.
With the Deutsche Bank CFO there sitting down with our very own Oliver Crook. Crook, good to see you this morning. From one suave CFO to a suave reporter. Talk us through the conversation. I mean, bonuses, private credit. What stood out? Good morning.
Yeah, man, it's really the headline here is the investment bank where really did the heavy lifting this quarter, up 13%, and namely in FICC trading. That, of course, took the sort of spotlight here for Deutsche Bank, up 7%. When you compare to what happened in the United States, where on average it was down 3%, and really the only U.S. bank to beat them was Goldman Sachs. That really is a standout, particularly when we look at the numbers out of Barclays and BNP today, where we saw fixed income trading down some 20%. They have certainly something to be happy about there. In terms of what it looks like going forward, he's seeing this sort of FICC trading moderating a little bit. There is some interesting sort of comments on the ECB slowing down a little bit in terms of the anticipation of where rates are going to go. He does see M&A coming back, but he must be said that it's a little bit disappointing from what he had expected when we spoke to him last quarter. What I think is interesting when we speak to Deutsche Bank is they lend obviously to the manufacturing sector, which has been basically dead flat for quarters and quarters. Now seeing the sort of green shoots there, seeing that the foreign markets to which they export starting to come back, so a little bit of positivity there.
Oliver, give the people what they want. What did they have to say about buybacks and bonuses?
That's right. For the investors and the bankers, it's all about the buybacks and the bonuses. Unfortunately, on buybacks, we're going to have to wait. We have that 3 billion euros sitting on the sidelines. They have not yet determined how much of that is going to go back to shareholders in terms of buybacks. But what I thought was really interesting was this conversation about bonuses, because the UK has changed the law in terms of how much they can pay out to their bankers. They have lifted the cap from the EU-era regulations, which means that now at the AGM, all these banks are going to vote on this. Have a listen to what von Moltke had to say about how that's going to affect the talent race in banking.
Look, we operate obviously globally competitive markets, and anywhere where regulation, by the way, for us it applies globally, the European regulation. And so it can put us at a competitive disadvantage. You know, we try to work within the rules and regulations that apply to us to be competitive on compensation, be an attractive employer across a whole range of considerations. But it's certainly a concern when regulations in the U.S. and the U.K., where we are active in a number of our businesses, you know, start to move in a way that places European competitors at disadvantage. So it's something that of course has our attention.
So that compensation question really is a big one for Deutsche Bank, where one of the cornerstones is to try to keep those costs down. And they went on this big hiring spree last year. And the concern is, are they going to be hamstrung by some of the EU regulations, not able to lift those bonuses in a sort of increasingly cutthroat environment for talent, which, as we know, is the lifeblood of banking?
Right, and they're all struggling with the same thing, perhaps overhiring and dealing with those costs. Oliver, thank you so much. Oliver Crook in Frankfurt, a fantastic conversation. Now to Barclays, they posted first quarter profit that topped analyst estimates. The bank's stock traders collected a surprise windfall from a volatile global market. Its CEO spoke with Bloomberg earlier.
Deal flow and the equity markets themselves have been starting to show some buoyancy. As I said, we are on our equity floor here, and then our own numbers and equities have shown an uptick for this quarter versus the same quarter last year. I think deal flow is increasing. You know, in our own energy business or our sustainability business and the transition business, we've seen 9 deals in the last quarter and a bit. And so I do think that there is a deal flow happening. I think, though, it's very early. You've got to give it a quarter or two to cement.
Is Barclays prepared to capitalize on that when it does ultimately come to fruition, when it does actually see a little bit more momentum? Is Barclays positioned to capitalize on that, given a little bit of an exodus in terms of your bankers, as well as lower advisory fees relative to your American peers? How do you tackle that?
Yeah, well, it has been and it is a very, very important area of focus for us. We want to increase what we do in M&A. We want to increase what we do in equities. We have hired a lot of very talented bankers. We are focused on the energy transition. We are focused across the important sectors of technology and healthcare. And so we absolutely are positioned to capitalize on it. And you should see the results over the coming quarters. It's not something that's won in days, weeks, and months, but over a longer period of time. And we've put the sustained investment and skills behind it, and we will continue to do so.
Can I ask you about M&A within the UK market, Venkat? We've got a bit of M&A taking place. Barclays, you yourselves in the process of acquiring Tesco's retail bank offering. We also have consolidation with Nationwide buying Virgin Money. The building society space, we see consolidation there as well. Is this a sector where we'll see more, and are you going to play more of a role in that?
Well, I think at any time you have an inflection in the interest rate cycle, as we have had, with changing capital models and changing consumer regulation, it stresses business models, and it therefore drives some amount of M&A. I think our own acquisition of Tesco Bank is something that's win-win for Tesco and for us. We were looking to grow our unsecured lending. And I think you will see other institutions look at that. We have been very, very clear. Our plan for growth is predicated on as an organic one.
Venkat Krishnan, the Barclays CEO, speaking with Bloomberg earlier. Let's bring in Tom Metcalf, our Bloomberg finance editor, who joins us now. Tom, so was it really just the equity traders that come in to save the day for Barclays?
Well, that was definitely a big surprise windfall, up 25%, right? And it's a complete contrast to what we were hearing about Deutsche Bank, where, Barclays rates traders really, Venkat calling out a bit of weakness this quarter. So a bit of a subdued performance there. So for me, the fascinating thing is actually comparing, the Barclays share price today with Deutsche Bank. And it's effectively the inverse of how the rates traders did. So Barclays up very strongly, more than 4% when I last looked, now about 3.4%. Whereas Deutsche Bank largely flat. And I think for me that shows all this focus on trading, etc. Ultimately, those shareholders are most interested in buybacks, as you said earlier, Danny.
Tom, obviously, you're talking about the stock price going in two different directions today, but are we comparing apples with apples when it comes to Deutsche Bank and Barclays? I mean, they have similar FIC businesses, but what is the big differentiator, let's say, between the two?
Yeah, I mean, they're pretty easy to compare just because they're among the few European banks with, I would say, substantive investment banking units. So, often people do just sort of shorthand them both as big fixed income houses. I think, in terms of comparing them today, a lot of focus is on, where are they going? And, that was a little bit disappointment for Deutsche Bank shareholders, I think, was there wasn't, as much clarity as Barclays was offering, say, on the NIM front and obviously on the buyback front as well. No real comms on that from Deutsche Bank, whereas Barclays on one of the calls, the executives were all saying, we are going to prioritise buybacks almost over everything else in terms of acquisitions or even dividends.
Well, certainly Barclays have had that activist shareholder in years gone by, and the investment bank has been, it's been like a thorn in Barclays' side in terms of what they do. Tom, thank you very much. Let's see if there's a little bit more activism to play for. China's luxury demand may be slowing for the sector, but it's not for Hermes. The French brand that makes the popular Birkin showed resilience amid slowing demand for competitors LVMH. And Caroline Conan is with us. There's nothing quite like a Hermes bag, is there? It is the ultimate symbol of resilience. Good morning, Caroline.
Good morning, Manus. I don't know if you prefer the Constance, the Kelly, the Birkin bag, perhaps.
I can't afford to buy her any of them. I can't afford to buy her any of them.
Well, a lot of people did in the first quarter because the sales at Hermes are up 17%, double-digit growth, even though the shares are actually down at the moment. Why? Because, of course, investors have already priced in a lot of these very positive Hermes story, and they are a little bit cautious about the second quarter and the rest of the year, because Hermes did mention this quarter that they've seen a softer traffic in some of their Chinese stores, especially for what perhaps you could afford, the cheaper products from Hermes, such as the silk scarves or the perfumes. Still, of course, there is a lot of polarization of the Chinese customers who tend to go these days either for the very high end, such as Hermes, or for the cheaper, more affordable products. That, of course, didn't play well for Kering. You saw the profit warning earlier this week. Hermes, on the other side, has a huge pricing power. They managed to pass on an 8% price increase just in the first quarter, even though they promised, Manus and Danny, good news for you, that there's not going to be any more price increases for the rest of the year.
Oh, good, Manus. You can save up for Christmas to get me one then. You've got plenty of time.
Aspirational luxury, Caroline.
I'll take a scarf even. Caroline Conan, thank you so much. Okay, coming up, we're going to set you up for the trading day on Bloomberg. It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day. Eco data will come out at 8:30 a.m. It includes GDP for the first quarter, wholesale inventories, and initial jobless claims. Then earnings on deck: Caterpillar, Airbus, plus more tech, Microsoft, Alphabet, Intel, and Snap. Then at 10 a.m. Eastern, the Supreme Court hears arguments on Donald Trump's bid for immunity from criminal charges related to attempts to overturn the 2020 election results. Manus.
Danny, a couple of punchy movers for you, surprisingly. Meta tops the bill, slumping. Disappointing revenue forecast, sparking concerns about the heavy spend on computing power isn't paying off. Zuckerberg is in retreat mode. IBM down 8%, the company's weak consulting unit sales disappointing investors, overshadowing its acquisition of the software company HashiCorp. And Ford is up 3%. It's all about the trucks.
It's all about Meta, Manus. This morning, all about Meta, those declines hitting the rest of the tech. Can Microsoft and Alphabet save the market today?
Well, the bar seemed to be low for Tesla and Elon Musk. The story there, the market believed it. A much more challenging time for Zuckerberg. Did he learn nothing in 2023?
Hard.